Happy Tuesday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Europe, Asia, and North America. My name is Tony. Let's jump in. And first up, gold and silver prices surged to fresh record highs at auctions on Monday, yesterday, fueled by a weakening US dollar and growing expectations of a US interest rate cut later this month. On the afternoon auction of the London Bullion Market Association, gold was fixed at $3,475 per troy ounce, surpassing the previous benchmark record set on the 22nd of April. On the spot market, gold climbed to an intraday peak of just $11 below its all-time high, also recorded in April amid financial turmoil sparked by the US Liberation Day tariff announcements at that time. Silver also rallied sharply, touching $40.76 per ounce, its highest level in 14 years. Mounting political pressure on the Federal Reserve has further buoyed gold's safe haven appeal. Investors remain uneasy after the US president's attempts to dismiss Fed Governor Lisa Cook and his continued criticism of Fed Chair Jay Powell. Quote, "The market is concerned about the strength of institutions in the United States more broadly than just the Fed," end quote, said Helen Amos, commodities analyst at BMO. Adding, quote, "That is naturally positive for gold in terms of safe haven demand." End quote. Gold has risen steadily for more than a week, tracking the attacks on the Federal Reserve. Powell's remarks at Jackson Hole, coupled with Friday's personal consumption expenditure report that met expectations, reinforced investor bets that the central bank will cut rates in its September 17th policy meeting. Lower interest rates typically enhance gold's attractiveness as a non-yielding asset. Beyond monetary policy, bullion's rally reflects broader anxieties about the role of the US dollar in global finance. Central banks worldwide have increased gold purchases this year, seeking to diversify reserves away from the greenback. Gold has gained 33% so far in 2025, supported by a cocktail of geopolitical tensions, inflation fears, and doubts over the resilience of the US economy. Silver, meanwhile, has benefited from speculation it could be targeted in the next round of Trump's tariffs. Analysts at Peel Hunt noted that while gold and silver have largely avoided trade measures so far, the threat of new levies has created fresh uncertainty. Last month, confusion erupted after US customs briefly declared gold bars subject to tariffs, a policy quickly reversed. With US markets closed for Labor Day, thin trading volumes on Monday amplified volatility. Still, analysts expect the combination of political risks, Fed policy shifts, and dollar weakness to keep both gold and silver well supported in the weeks ahead. Next up, we move to Europe, and for our purposes, Turkey is part of Europe. Turkey has lifted its ban on short selling the country's largest stocks, ending a 6-month prohibition imposed during political and market turmoil earlier this year. The move signals growing confidence among regulators that financial conditions have stabilized after months of volatility triggered by the arrest of an opposition leader and Istanbul mayor, which we covered at the time. The ban, introduced on the 23rd of March, followed the political leader's detention on corruption charges, which sparked mass protests, a sharp investor sell-off, and a steep decline in the lira. To contain the crisis, the central bank raised interest rates sharply and spent an estimated $50 billion defending the currency. The leader, President Erdogan's most formidable political rival, remains in jail. The short-selling restrictions applied to blue-chip companies listed on the BIST 50 index. They expired at the close of trading on Friday and were not renewed by the Capital Markets Board, Turkey's financial regulator. Quote, "It shows the authorities are feeling more comfortable with the market, and the market should take it as a positive signal, even if it only takes things back to where we were," end quote, said a portfolio advisor at East Capital in Dubai. The end of the ban coincides with broader economic shifts. Last week, Ankara also closed a costly crisis-era savings program known as KKM, which offered guaranteed lira returns to stem capital flight. The finance minister and central bank governor have led a 2-year reform drive to restore orthodoxy, cut inflation, and rebuild foreign reserves. Reserves reached nearly $176 billion in late August, though net reserves remain below their pre-crisis levels. Markets have reacted with relative calm. The BIST 100 index was little changed on Monday, though it has gained around 15%. Still, returns remain well below inflation. GDP growth has accelerated, rising 4.8% year-on-year in the second quarter, beating forecasts, while inflation has slowed to 33.5% in July from a peak of 75%. Analysts say the lifting of the ban may boost liquidity and restore confidence among international investors who have long been unsettled by ad hoc market restrictions. MSCI has previously warned that Turkey risks being downgraded from emerging to frontier market status if such interventions persist. Risks remain, of course. Dozens of opposition leaders have been detained, raising concerns over political stability ahead of a crucial September 15th court hearing on the Republican People's Party's future. Meanwhile, business continues to suffer from high borrowing costs and a strong lira that has weighed on tourism, with arrivals down 5% in July. Despite these challenges, policymakers have emphasized disinflation as evidence that reforms are working. The central bank expects inflation to fall to as low as 25% by year end, though that remains above its official target. Next up, we have one more development to cover, but just quickly, if you want to be on top of the biggest developments in the world's most important markets through grounded and sober analysis, just the facts, no political punditry, consider subscribing to Market Update. Hit the bell notification icon and you will be. And if you'd like to help keep the channel financially sustainable, there is a Buy Me a Coffee link in the description below. This is a big help. Thank you so much. Now we move to Asia. South Korea's consumer inflation cooled to its slowest pace this year in August, raising the likelihood that the Bank of Korea could resume monetary easing at its next policy meeting in October. The nation's consumer price index rose 1.7% from a year earlier, down from July's 2.1% increase, Statistics Korea reported today. The figure undershot economists' expectations of 1.9%, largely due to a one-off plunge in communications costs. Core inflation, which strips out volatile food and energy prices, slowed sharply to 1.3%, the weakest reading in 4 years. The primary driver was SK Telecom's decision to halve mobile bills for over 20 million subscribers following a data breach, dragging communications costs down more than 13%. Analysts caution the effect will fade next month, setting the stage for headline inflation to rebound toward the Bank of Korea's 2% target. The slowdown provides room for the Bank of Korea to reconsider easing policy as the economy navigates headwinds from US tariffs and a frothy housing market. Policymakers left the benchmark rate unchanged at 2.5% last month, citing concerns over rising mortgage debt and property prices. Governor Rhee said inflation forecasts were nudged up to 2% for 2025 and 1.9% for 2026, showing the central bank's caution. Quote, when defining price stability, the Bank of Korea doesn't only look at consumer prices, but also takes into account changes in housing and rents. Given that more than half of the population lives in the Greater Seoul area, real estate shifts have a significant impact, end quote, the governor said last week. Despite tariff pressures from Washington, South Korea's trade performance has been resilient. Exports rose 1.3% year-on-year in August, the third straight monthly increase, driven by a 27% surge in semiconductor shipments and a 9% gain in autos. Shipments to Southeast Asia jumped nearly 12%, while exports to the United States and China fell 12% and 2.9% respectively. However, new US restrictions on Samsung Electronics and SK Hynix's use of American technology in their Chinese plants could cloud the outlook. While near-term impacts appear limited, longer-term risks include production slowdowns and heightened uncertainty in global chip supply chains. Economists expect inflation to climb above the target in September as the telecom discount expires, but say subdued demand and manageable price pressures could give the Bank of Korea scope to lower borrowing costs at its meeting in late October. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Tuesday, and I will see you for another episode tomorrow.